Mark your calendars for September 17th because that day could reshape your mortgage, your savings, and your investments. The next FOMC meeting is coming up, and markets are betting on a rate cut. But two critical reports, the jobs and the CPI, could change everything. Now, here's what's happening, here's what's coming, and what it means for you. Let's get into it. So, the next Federal Open Market Committee meeting is coming up in September. It officially wraps up Wednesday, September 17th at 2 p.m. Eastern Standard Time. And that's when we'll see the official policy statement, the dot plot projections, and hear from Chair Jerome Powell himself. Now, this is one of 4 meetings each year that includes the summary of economic projections. That's where the Fed officially lays out their forecasts about inflation, unemployment, economic growth, and the path of interest rates through 2026. Now, according to the CME Fed Watch tool, markets are pricing in about an 89% chance of a 25 basis point cut at their next meeting in September. It's not 50 points, not multiple cuts, just a quarter point. And even that isn't guaranteed because the Fed's still going to be looking at the next round of data before making its final call. Now, let's look back at the most recent jobs report for July. The economy added just 73,000 jobs. That's far below expectations. And on top of that, May and June were revised down by more than 250,000 jobs. Additionally, the unemployment rate ticked up to 4.2%. Consumer sentiment dropped as well. Now, that's a clear sign the labor market is cooling, and it gives the Fed more reason to consider cutting rates. Now, let's look at inflation. The July headline CPI held steady at about 2.7% year over year, but core CPI, which strips out food and energy, jumped to 3.1%, up from 2.9% in June. And that's the biggest jump we've seen in 6 months. It tells us while overall inflation is stable, underlying price pressures are rising, and tariffs may already be playing a role. So what's coming next before the Fed meets? The August jobs report is due Friday, September 5th at 8:30 Eastern Time, and the August CPI report follows on Thursday, September 11th at 8:30 Eastern Time. Now, these two reports are a make or break because if they come in soft, the case for rate cuts strengthens, and if they surprise to the upside, the Fed could delay action. So here are the scenarios. If jobs weaken further and inflation stays cool, the Fed will likely deliver a 25 basis point cut with a dovish message. Markets could rally and bond yields would fall. But if core inflation runs hot again, the Fed may hold steady, even with markets expecting a cut, which would be a shock, and it could trigger volatility across stocks, bonds, and currencies. Now, here's what all of this means. Mortgage rates, car loans, and credit cards could ease a little if the Fed cuts rates, but high-yield savings accounts may slip lower. For investors in sectors like tech, housing, and REITs, they usually rally on rate cuts, but short-term bond yields react first and the fastest. Now remember, Powell's tone in the press conference and the dot plot outlook could move markets just as much as the rate decision itself. So what do you think? Will the Fed cut rates at its next meeting? Drop your thoughts in the comments and we'll see who gets it right. Now, thanks for watching. If this breakdown helped you understand what's ahead, hit like, tap subscribe, make sure to ring that bell, because I'll be back with a reaction coverage the moment the Fed speaks. And I'll see you on the next one.